Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome, podcast listeners. We have an awesome show for you today. He's been requested by many of you. Our guest has a background in academia, econ, fund management. He's worked as an economist, set up value at risk systems for trading desk at KeyCorp. He has spent time managing money, starting his own funds, did a PhD, written a couple books you may have read, Finding Alpha and the Missing Risk Premium, and then a whole slew of white papers. Welcome to the show, Eric Falkenstein.
Well, thank you, Meb. It's a pleasure to be with you.
We're tuning in from Minnesota, which it's like one of the 5 states I've never been to. It's on my to-do list. Are you an ice fisherman yet?
No, but the fun thing is, my old firm, when the guys would come out from New York, we'd take them ice fishing in the winter, and then they would never want to come back because they thought like that's all we did. But we thought, if you're going to come out to Minnesota, you should do a Minnesota thing. We're not going to take you to Buffalo Wild Wings. You can do that there.
My brother is a big ice fisherman, and I say, Wayne, I'll do it with you once every 5 years just to have a little brotherly quality time. But they don't do it quite the way that people in Minnesota do it. He's in Colorado. I mean, it's like a tent and a heater, and that's about it. The true pros have those like cabins with a record player and whiskey and music. That's the way I want to do it. So anyway, but being in the cold and staring at a hole is not my favorite. So
it's really an excuse to get away from your wife and drink beer. So.
Yeah. All right. Well, I like that part. By the way, I got to give you a great compliment. You're one of the last holdouts of the bloggers out there that still use the old school Blogspot platform. I think you still do, right? I think it's Professor Damodaran from NYU. And there's like 3 or 4 others. I love it. Please don't ever change. It's I have a very soft spot. We started out on that many years ago. So I love it.
Well, I don't do it much anymore. I'm not a big blogger anymore. I just the value isn't there for me now. So I just
it's shifted. See, now it's on podcasts, so you'll get lots of crazy responses that you would have used to get on the blog on the podcast. All right, let's start chatting. So let's go back to the origin stories. I want to hear a little bit about some of your early beginnings. You covered a lot of ground in kind of academia. Why don't we walk back there? Talk to me a little bit about your path of how you got into this sort of econ beginnings and the origins of what we're going to talk about the rest of this talk today.
Well, I went to WashU as an undergrad, and I got into econ because I was a TA for Hyman Minsky, and he was like my mentor as an undergrad and made me want to get a PhD. And so I thought he was really cool because he was really down to earth, and he was really iconoclastic in the sense that he didn't get along with the Keynesians, and he didn't get along with the monetarists. And so I just found his attitude really fun. And I still disagree with him on like a lot of things, but he did tell me one thing I'll never forget, which is when I was like 20, he said, just don't think you're going to know everything until you're at least 30. And I remember thinking at the time, oh, what an idiot. I almost know everything now. And I didn't realize that he could have probably added 10 years to that. But he was really good. And so then I took that. I wanted to be a macroeconomist because it predict business cycles. And, he had his own little boom-bust theory. But as much as he's like popular now, his basic idea that economies are endogenously unstable, I agree that's true. But other than that, you really, he had this idea that basically you just lever more and more during the cycle. And that's kind of true, but there aren't any aggregates of that. So, and I found that was true in everything in macro. Everything you tried didn't really work. So I kind of jumped ship in grad school at Northwestern and got into finance, because at least, I was always interested in stock markets. When I first got out of school in 87, my first trade, because I had like $5,000 because my grandma died, and so I got $5,000. And so my first trade, I actually bought a put on the S&P 500 on October 16th, 87. And so I hit a home run. I made like $42,000 in 2 days.
That's got to be the most amazing origin story for anyone's first trade. I mean,
that was my first. So I thought that was really cool.
But also, that's probably like the worst possible first trade that could ever happen to someone in their 20s. Now you're like, I'm George Soros. I'm gonna soon be worth $500 million because
if you love somebody and they go to Vegas, you want them to lose the first day. It's definitely true. Yeah, because then I realized. After that, over the next year, I said, oh, I'll just do this full time. But, the spread and the taxes, and it killed me. But anyway, I just really hooked on like the markets and trying to figure that out. And so, so I went to grad school and I tried the macro stuff. I found none of those guys know what they're doing. Even today, they're still arguing about the same stuff. They can't predict business cycles and they can't predict long-term growth. It is like nobody predicted what is it? The 5 Asian tigers were going to take off in the early 80s. Nobody predicted West Germany would take off after World War II. And nobody knows why Haiti is poor and Iceland is rich. Economists disagree on that. So it's kind of pointless. So anyway, finances I thought was fun. But then I got into that. And then one of the first things I found was that, volatility didn't have a premium. And so I wrote my dissertation on that and said, hey, high vol stocks actually have a lower than average return. And that was my dissertation.
What was the inspiration for that? As you were just kind of kicking around, reading about finance, was there ever kind of you were just playing around the numbers? Because you were really early to this. So this is probably early, mid-90s at this point. Not a lot of people talking about this. What kind of led you down that path? And was it something where you kind of scratch your head and say, man, I'm really onto something. This is really cool. Or you're like, am I just an idiot and the rest of the world understands this and I don't? Or like, what was the general aha sort of process?
Well, I've always just had I've been disagreeable in the sense of I always think like Minsky, everyone else is wrong. And so, that's kind of a personality disposition. But, I had the standard SAS access to the CRISP tapes, which all the PhD programs have, right? So we had all the access to all the, and so one of the first things you can do in SAS is to do these decile sorts and stuff. And so, I calculated volatility, all these metrics, and I rank them from low to high and look at the monthly returns of the portfolios. I remember I found the momentum thing was one of the first things I found. And I was doing this in 92. And around that same time, Jagadish and Titman published the momentum paper, the first momentum paper. And I remember I found it and a month later, it was published, which means Jagadish and Titman probably figured it out 2 years earlier. But anyway, I thought it was cool that I found something before anyone told me about it. So I thought, I'm not seeing things. And then I found this volatility thing. I calculate volatility. The trick was you got to get rid of the small stocks because the little small stocks have really high volatility. And you get this weird bias to returns when you look at small stocks because they have crazy bid-ask spreads and such. The whole thing that caused, the size effect initially was thought to be around 15% annually. And it was all just because of mismeasurement issues with the bid-ask on the small stuff. So I got rid of the small cap stocks. If you got rid of the low price stocks, really, the returns for highest vol were lower than average. And I knew that didn't make any sense. And so, but it was so new then, it was actually too new. It's sort of like, Apple and the Newton, it's good to come up with new ideas, but you don't want to have them be too new. If I would have done this, in the late 90s after Freakonomics and behavioral finance got hot, it would have been more, I don't know, it would have been accepted better. But because it was, I didn't have a rational explanation for it. And Northwestern's kind of like Chicago. Those guys are all like, well, you have to have a theory. You can't just find something because that's just data dredging and you're just finding meaningless noise. That's the way things are done now. But back then it was, no, you have a theory and, if you just find something but there's not a rational explanation, then you're fooling yourself. It's not real. So I wrote up this story about how mutual funds are attracted to sexy stocks, and I got that published in the Journal of Finance. But the asset pricing one, was rejected because it just didn't make any sense. And like I said, that was just too early. Like 5 years later, they would have said, fine, if you found something, we'll publish it. But that didn't fly then.
It's funny because I was smiling as I read through a lot of your comments on the publication process and how kind of humorous that was. Because, when we published our first academic white paper, being someone that had never been through this, it was such a odd process to me. I mean, it had all the earmarks of something you wouldn't expect out of a theoretical academic process, where people totally came to the table with their preconceived notions, where there's definitely an element of clubbiness to it and all these other things and it's changed a lot in the ensuing couple of decades. But what was the process of trying to get this published? The idea, was it just kind of universally shut down? Were people dismissive?
They were all just very dismissive. Like one guy said, I'm trying to tell him that the world is flat or something, because they said, it can't be. And it was just incredulity. I mean, there was nobody high profile. You need some big guy to say, oh yeah, that's a good idea, because otherwise the people okaying your paper are going to feel stupid. So, and I had no big guy backing me. My dissertation committee was actually, most of those guys were like game theorists. I had one finance guy, but he was a junior faculty guy. So that's why, I could get my one paper done on mutual funds, because it was it wasn't that radical, but the volatility finding was just too radical at that time. Looking back, we see other people found it too, but they would just kind of mention it parenthetically, like Haugen, had some papers finding it and other people, but they just mentioned it as an aside. I was emphasizing it, and they're like, well, no, this can't be true. And so I was perfectly fine with that, because I thought, oh, great, I'll just I'll set this up as a fund. And so I got a job as an economist, but I was busy trying to create my own fund. And that's, the first thing I did. And I tried to create this low vol fund but, and I created the C Corp with my family money. So, I put a couple $100,000 in there, and then I would go to New York, and try to sell it to some people. But the problem was, it was just so simple. It wasn't sexy, because I just said, hey, low vol you get another 100 basis points, 200 basis points for low vol over the S&P, and you get 2/3 the risk. And that didn't work for two reasons. One is they would just say, well, this can't be true, because if it was true, everyone was doing it. And then another thing they would say is, well, basically, I would explain it so well, they're just figuring, well, that's nice, but now that you've told me kind of the whole thing, I wouldn't want to hire you to do it, right? Because there's no. So yeah, it was just a massive failure on my marketing end, and and then by the early 2000s, you had people like Pim Van Vliet and Unigestion started funds around 2004, and they were just in the right place at the right time. Pim just got lucky and had a good manager that allowed him to do his thing, and then they took off and became history. So I missed it by a big amount. But I mean, I tried to set up another fund later, because I'd been in hedge funds by then in 2006. But unfortunately, my old boss sued me for violating a confidentiality agreement. And then, after I got out of that, no one would touch me, because it was kind of vague and no one wanted to deal with the risk. So my second trial to start a fund, when it really started to take off, that got whacked too. But then I applied it later. I was doing low vol stuff at my last hedge fund, and it worked fine. But that fund, outside of me, it was a $5 billion when I got there, and it went down for other reasons. I was one of many PMs there, and they no longer exist.
Talk to me a little bit about some kind of what you learned about the practical implementation. So you kind of spent some time managing the funds. Did the results play out sort of as you had expected to? And was there any sort of conceptual takeaways for running the strategy in the real world, or is it pretty much what you'd expect?
Well, looking back, I think the essence of it, its value is really straightforward. It's just low vol, and it's a flat maximum. It doesn't matter if you use daily vol the last 6 months or 2 years, or that doesn't really matter that much. And it works almost in every market. Or I think it does work in every market. But adding layers onto it, I found, was always kind of like a red herring. It was kind of essential, because if you just told someone you're doing low vol and trying to arb stuff that way, no one would give you money to do that. So you had to add another factor, even if it didn't work. But that was all sort of a compromise you had to make in order to get someone to do it, because no one wants to do just low vol. So, everyone has, AQR's got their low vol fund, and it's got, what do they call it? Defensive. And then, PIMS at Robico, they call theirs conservative. And, he's got extra factors. And, but the extra factors are just tricky. I'm not really a big fan of any of the other factors. I'm sure you're aware that like value is getting beaten up, and, it's a tricky one. How do you measure value? And I don't have a lot of expertise in those, and I don't have a lot of confidence in them. But to the extent that the low vol thing works, I think it's just really captured very well by the SPLV ETF. And so, yeah, there are ways to make it better by doing it internationally, I think, and diversifying. But other than that,
I want to. You mentioned a couple things I want to touch on real quick, and the first is, you kind of came up with this research before many people did and understood it. As you have seen in the ensuing couple decades, a couple things. One, what do you see as the main value proposition? So is it behavioral? Is it that do you think it's smoother returns, potentially better returns, but also, why do you think it really persists? I mean, and this may tie into your first academic paper on people being attracted to lottery stocks, but what have you learned in the ensuing 2 decades that kind of tells the story in a way that makes sense to you as to why would this continue to persist, and why do people continue to do dumb things?
I guess the key is that, the CAPM, when they derived it, everyone just thought it worked because it made sense. And when they first tested it, the real first test was when those guys at Chicago, created the first CRISP tape, and they found out that, equities had like a 7% premium over bonds. And so they're like, hey, this was, 10 years or so after the CAPM was developed, or no, right around the same time the CAPM was developed. And so they're like, oh, the explanation is, higher beta stocks, higher risk stuff gets this risk premium. But it doesn't generalize to anything else. I mean, we know that the equities return more than bonds, and that's a good example of a risk premium, but it's like the only one. I mean, you have that, and then you have the return of triple B bonds over treasuries or over AAA, but you don't have a lot of other places. I mean, if you look in sports gambling and within stocks, it doesn't show up. And my big thing is people are more relatively oriented than absolutely oriented. So if risk is what everyone else is doing, then, if you invest in stocks, the spiders are at low risk. So tracking error is your risk. Your risk is not your absolute return. It's your return relative to what everyone else is looking at. And that makes just a lot more sense from an evolutionary standpoint. It just seems to show up again and again that people are more relatively oriented. And if people are relatively oriented, then a high beta stock has risk, but so does a low beta stock. So, there's no risk premium in that dimension. And then the high beta stuff has all this extra sexiness that people like. I mean, people are overconfident. That causes you to apply your great alpha to the high flying stocks, not the boring ones. Information costs. High flying stocks are written about all the time. They're generating news. There's alpha discovery in the sense of if you're going to get into the game, you don't want to pick Coke versus Pepsi. You want to pick Facebook versus Apple or something that's going to move around a lot. And so and then generally equity investors tend to be bullish because you wouldn't invest in equities unless you were bullish. And conditional upon the stock market going up, well, then you want to be in high risk stocks. So there's a bunch of sexy reasons why people are glom onto the high beta stocks, and there's no premium for it. So they pushes those down, and the security market line is flat otherwise, I think. And that gives the low vol stocks not so much a premium, but because high vol stocks are part of the index, that means that the low vol stocks kind of just tend to outperform by a couple percent a year.
So now we have kind of the low vol phenomena seems to be fairly well accepted in the community. There's now a debate raging. Raging is probably the wrong word. You can't really have a raging quant finance debate, but if it was, that's it. Where people have been talking about various factors like low vol investing, which historically works great, but the capacity to say that there's times when this may work better, whether through regimes or Research Affiliates talks a lot about this, where they say there's times based on valuation of the underlying stocks, meaning a factor can go in and out of favor, such as the late 90s, value is out of favor. Certainly in this period, value has been getting pummeled by the pain train for this almost entire cycle. What's your thoughts in general on that concept of looking at factors through the lens of either your economists had of different regimes or also of potential valuations where they're either in favor or out of favor? And do you think it's possible to ever time those?
I tried that a lot because, when I was applying this at various funds, a lot of my bosses would say, well, why don't you look at the price to book of your strategy now and compare it to earlier times? And, it makes a lot of sense, right? Because if previously my, the strategy of going long low vol stocks had a relative value metric that made it different currently, it would make you wary. But historically, I didn't find it really worked. It didn't help me time the cycle. There's one exception, of course, which is the internet boom. There, obviously, all the metrics kind of like highlighted that, the internet stocks were overdone and relative to the boring stocks. But other than that period, that little, period where it went way up and way down, trying to find those valuation metrics to time a factor, be it, value or whatever factor, size or momentum or I don't know, whatever the cool factors are now. I haven't found them to work at a sample where you kind of like handcuff yourself and come up with a rule where without looking forward, you determine whether it's high or low. Yeah, I never found any of those to work, unfortunately. In the same sense of like you look at CAPE, right? You can look at the whole sample, like look at, what do you have? Who's that guy? That guy at Yale. He's got that. Schiller. Yeah, so he's got his like Excel sheet, right? And you can look at the PE over time. And you can just go through that Excel sheet and say, okay, what if I took, if I had some dynamic rule to get in or out of the market based on the PE? And if you confine that rule looking backward, it's hard to create something that adds value to just being long. I don't know. Have you tried that exercise? I know you like to play with it.
Oh, yeah. We've spent a lot of time with the CAPE ratio. And yes, I agree. I mean, look, market timing is tough in general. I mean, you'll smile at this. When we wrote our very first white paper, the original title of it was A Simple Approach to Market Timing. And my God, you should have seen the reactions to that. People, every single person I sent it to just pulled out their hair. They wouldn't read it. And we were trying to get it published. And then we changed the title to A Quantitative Approach to Tactical Asset Allocation. And it was literally night and day, Eric. You have no idea how people responded to it as if like, so, in our world of investing in finance, like you mentioned, so much of it is just kind of how you frame the argument. So instead of calling it low vol, you call it conservative or whatever it may be. And so market timing, yes, I think there's plenty of metrics that I think help, but in almost always they don't help the way that people think they help. Most people, individual as well as a lot of institutions out there, when they think of market timing, they're looking for a magical elixir that's going to tell you when to sell at a market top and buy at a market bottom. But in reality, whether you're using trend or whether you're using valuation, they tend to be fairly blunt tools. And likely what is the net effect? Yeah, they'll probably reduce your worst case drawdown, but those drawdowns don't happen that much. It's a kind of once in a generation sort of thing. But we have found value, but it's not, it's not the holy grail. But it's funny too, because we say, well, wow, Shiller's goes all the way back to 1880, and then there's Global Financial Data just put an update for CAPE ratio back to like 1810 or something. And what did the world look like back then? Well, certainly not what it does today. So it's a little bit of it's just trying to, in my mind, a lot of those rules come down to common sense, and so you can apply CAPE ratio globally to countries like all the countries in the world, but it gives you more than anything an understanding of history. So saying, hey, did it make sense to buy Japan at a CAPE ratio of almost 100 in the 80s? And those things then don't pass the smell test. So it's simply using value or low vol or some of these factors. I think it helps, but certainly the market cap weighted indexes are a high hurdle. Anyway, so yeah, we could spend 4 more hours talking about CAPE ratio. That tends to always.
Well, the thing is, like my old fund actually, they kind of like got they got really pushed up into the upper tier because a guy there I work with for Steve Kuhn, he made a great timing call on treasuries in like 2010 and said, that these mortgages actually are gonna rebound, and he was right. And you get one of those big timing calls, a big thing like that, right, and you make a lot of money for people, and you get a lot of benefits. But they're so sui generis. I mean, they're so infrequent. It really doesn't say much about your alpha in general. It just means if you were right about mortgages coming back in 2010 when people thought they were going to do a double dip, great. But as who was that famous guy? Was it Paulson or something? He called that whole thing right, and then I think he kept thinking the treasuries were going to crash for the next 8 years and was wrong. And so, yeah, those timing calls, they can make you a lot of money, but I think it's irrational to like extrapolate alpha from those.
We've had a couple good guests on the podcast that have framed it. So many investors on the timing side want to think in binary terms where, hey, stocks are expensive and they're in a downtrend. I got to be in or out. And the way we often tell people to think about it, and psychologically and behaviorally, that's probably a lot easier to handle is, somewhere in between where you're either calibrating your portfolio or the fancy technical term we call going halvesies, where, you're not necessarily going all in or out on some of these ideas, but rather you're tilting away from. That's the way we think about it. It's really hard for people to think in binary terms, although almost everyone wants to, because they secretly want to gamble.
The one timing call I would call now is, I do think it's a bad time to be like long bonds. Interest rates have gone back up a lot in the last year, but they're still historically pretty low.
It's funny if you look at bonds, and we're talking about sovereigns, and you look at them globally, the U.S. has now inched its way, despite not being that high versus history, into sort of the top quartile of, I believe, of high yielding developed market and emerging market bonds. And so it's a bunch of emerging market countries like Greece and Mexico and Russia, and the U.S. is in that bucket now, but that's not as much a comment on the U.S. It's a comment on how crazy still the rest of the world is on these super low yielding sovereigns of well below 1% in many, many countries around the world, which is probably been the biggest surprise in my career, seeing negative yielding sovereign bonds. As an economist, that probably made a lot of your former colleagues scratch their head a lot. That's kind of
a no one would have predicted that, especially for so long. I mean, it's happened. It's gone on for now like almost 10 years now. It's crazy.
You had a fun quote in one of your papers, and I want to use it as a kind of transition point where it stood out. You said you need some sort of delusion focused on low volatility stocks that causes some investors to reach for the high beta assets outside of the standard model. So wanted to ask, is this something the general thinking and theory applied to low vol in the equity world? You mentioned very briefly in passing earlier global. So one, is it something that you see that translates well to global, but also does it translate to any other asset classes? So currencies, bonds, we just talked about, commodities. Any thoughts there?
Yeah, the idea there is, you can get a flat relationship between risk and return, but to get the high vol stuff to have lower than average returns, there's no rational way you can do that without just and so you have all these irrational things like people being overconfident and stuff like that, and risk loving and trying to show off but yeah, it does translate to a lot of different areas. You have look at like options, they're really out of the money options. Those things have horrible returns. If you look at those, penny stocks have horrible returns. And those have really wild volatility.
Where do you fall on the extension? I don't know the answer to this, but I haven't heard you comment on it. But one of the big, on a portfolio level, conceptual theories is when thinking about volatility is the concept of when building a portfolio, either normalizing levels of volatility or trying to optimize on correlations and then levering that portfolio. The main one that many would consider to be risk parity as an idea in the portfolio context. Do you have any thoughts on that? Is it a pass? Do you think it's interesting, not that interesting?
Yeah, I'm not really a fan of the risk parity stuff. I just think within any asset class, like bonds. But I would separate bonds into, you have high yield bonds and then you have investment grade bonds. But within those universes, within junk bonds, you want to be in the safest junk bonds because the higher volatility ones have no higher return and they have a lot more risk. Same is true within emerging markets, and the same is true, within maturities on the bonds. I mean, why go out 30 years when you can go out 5 years, get the same return and a lot less volatility? You can do the same thing on currencies and everything else. Sports books, obviously, if the 100-to-1 long shots, they have a low return. So compared to the 2-to-1 guy. Of course, if you're betting, it's for fun. So when I bet at the horse racing, I bet on the 100-to-1 too, because who wants to make 100% at the racetrack, right? It's you want to make 10 times. But
well said.
But that's just play money. But within any grouping, I think it always pays to just go for the most boring stuff when you're talking about real money, because it's not sexy and because it shows humility. And humility is very important, and most people don't have it. It's one of our big sins. We all think we're smart and smarter than every, especially quants. We all think we're smarter than average because all of us quants were probably better than average compared to our friends in high school. But, everyone there's a lot of other smart people too, and everyone's looking at the same data.
Believe me, I just got back from the world's largest cannabis investing conference in Las Vegas, where there was 25,000 people, and I think pretty much everyone there is looking for an 1,000-to-1 long shot. There's so much money sloshing around, including I took a photo and posted to Twitter of one booth that had a sign that says money grows on trees, which I thought was pretty good description of the current mood and vibe there. Although it was the first conference I've ever been to where I was at the institutional investing session, and the table to my left was drinking beers and the table to my right was smoking. So I think it's a little different vibe than my normal quant conferences.
Well, you see this all the time in when people advertise, no one ever advertises and says, I'm going to outperform by something reasonable and feasible. Like, I'm going to outperform by 3%, with the same vol, or I'm going to have the same return, but 20% less vol. Those are very feasible outcomes, but it's really hard to sell. And you see all the time, like the Motley Fool is always. I had one pop up that said, make 200% on your money over the past 3 years or something, and they want the home runs and stuff.
The catnip. The Motley Fool has certainly gone down that rabbit hole pretty deeply. That their advertising, they used to be kind of a very investor-friendly focused platform, but yeah, whoever's in charge of their offerings and advertising department, it's getting pretty icky. But it's funny, even on the institutional side, I can't tell you how many, despite not investing in private funds, how many fund offering docs we get that says targeting mid-teen returns, targeting 20-25% returns. And I laugh because I said, I'm going to have to change all of our marketing material to say we're targeting some obscenely high number. We're never going to get it, but we're targeting it.
Yeah, it is kind of strange. You'd think an institution would be smarter than that. Because I left my old hedge fund because it was just floundering, and so they ran out of money. And I thought, okay, I had a decent Sharpe there personally. I had like 1.3. I was making money every year. The average fund doesn't have a 1.3 Sharpe, and I thought this would be great. But every headhunter I talked to was like, no, you need a 2 Sharpe. And I thought, you got to be kidding. If 2 Sharpe's the bar to get in, and these are individual PMs, then every hedge fund should have like a 3 Sharpe. And we know that's not true. So, why are you asking for Sharpes that are not reasonable? But it is what it is.
Sharpe ratio is the old school sort of, if you're not familiar, listeners, it's like the risk-adjusted return metric where asset classes over time have about a 0.2, 0.3. A good asset allocation portfolio gets you up to about 0.4, 0.5. And so really anything above 1 is over time world-class and theoretically should put you sort of in the ring of fame. And so 2 and 3, by the way, is not sustainable. And so we did an old post years ago called Where Have All the Sharpe Ratios of 1 Gone? And we looked at this was for commodity trading advisors, but it applies to hedge funds as well, and looked at funds Sharpe ratios by age and how long the strategy's been around. And so certainly after a couple years, you had some that had Sharpe ratios of 2 or 3. By the way, the S&P can have a Sharpe ratio of 2 or 3, in short periods.
And in 2017, I think it had a daily Sharpe of 2.
Yeah.
It was high because the vol's so low and it went up 17%, I think. And
yeah. First year in history, the stock market didn't have a down month.
right.
And so, but the funny thing about our study is as the years went by, as you went 1, 3, 5, 10 years, all the Sharpe ratios declined below 1. And so there was none, I think it was none that had a Sharpe ratio above 1 out past like 10 years or something, because eventually, that's, strategies, it's tough to maintain an edge, but also markets, almost any strategy goes through periods of 2, 3, 5, 10 years where, unless you're Renaissance, that they struggle.
It's puzzling to me because, these are sophisticated people at these big funds. And, and funds, the hedge funds, I think, I haven't seen the data aggregate lately, but, they do okay. But I don't know, how can they hire PMs with this kind of delusion? And I just wonder if maybe they're just getting they're doing kind of a style momentum. That is, if you're a fund and you have 30 different strategies and, whatever, it's like pairs and you have a volatility strategy and something else, and something maybe is momentum based. And so if you just glom on to whatever's worked over the past 2 years and generated a 2+ Sharpe, maybe that strategy tends to do okay. I'm thinking that's the only rational explanation I can give for.
I think there's a much more rational explanation, and that's the old Chinese proverb that fish see the bait but not the hook. And what these hedge hunters and fund managers, everyone's sort of in on the secret of they're out there selling the sizzle and this dream that I think it's with the internet, acting as the global disinfectant, it's becoming harder and harder to sell that, sort of dream, which is why hedge funds, so many of them, and hedge fund is just a structure. So it applies to a lot of things, but have really struggled in particularly this past cycle, has been a graveyard for a lot of famous funds. But the challenge of, who said it? I think it's Ray Dalio said it, largest hedge fund manager in the world, said, there's not 10,000 good pilots, referring to the 10,000 plus hedge funds. By definition, it's hard. So anyway, there's a couple other things I want to talk about. So, and we only have limited time, but I have 3 more pages of questions we're not going to get to. But one of the things I'd love to transition to is sort of the career arc. You're now starting to think a little bit about the cryptocurrency space. Maybe talk to me a little bit about what attracted you to that world. It sounds like an economist's dream. If there's ever been a more fun experiment than crypto, I don't know what it is, but Talk to us how you kind of got interested in that world.
Well, yeah, I just started reading about it, and I really got into the whole. First, it's just the technology is really. It's not really technology; it's the conception, that whole Diffie-Hellman key exchange, the proof of work, and I just thought that was just cool. It's just kind of interesting if you're a geek kind of person, a quant person. And then, I've always been a libertarian, so it jibed with that part of me as well. And I also think that, we're going to inflate our way out of all of our problems eventually. So, it makes sense in the long run to get into these things. So all that stuff kind of came together. And then, as I mentioned, I wanted to be, apply my old strategy, but I was too honest and said, well, I can give you a low 1 Sharpe, and there was no interest in that. And so I said, well, I thought I'd eventually find somebody who'd be interested in a low 1 Sharpe, but I never did. And so I said, well, screw it. I'll just get into this crypto stuff. And it's been fun. It's just, obviously, right now it's going through a tough time, but I think in the long run it's going to work. And I'm really working now on just trying to find legal ways, to do this, because there's so many constraints on setting it up as a fund, because everyone's afraid of what, all the risk. And finding safe ways, because, it's really safe, but, you forget your password all the time. Well, here, if you forget your password, you don't get your money back. There's nobody to call. So you have to come up with mechanisms so that it's both safe, but you also, you'll also never forget it. And it's just, actually, that's a fun problem. But then coming up with ways to, there's so many horrible things out there unfortunately, our regulators thought they're going to save us by not letting us trade them. But if the regulators let us short these stupid altcoins last year, it wouldn't have had the stupid bubble that it did. But you couldn't short any of that. So I'm still working on trying to figure out ways to do that because almost, 90. Well, there's a famous saying by that novelist that 90% of everything is crap, and that's definitely true for this space. And so there's lots of stuff that's worth zero, and it's. I'd love to short it, and I'm trying to figure out how just feasibly, because you can short this on various exchanges, but you can't do it as a fund because it's technically illegal for a U.S. person to do it. So you got to figure out a way to do it. What people generally do is they lie and they go through VPNs and pretend they're living in Mexico, but you don't want to do that as a fund because that's not legal. So anyway, yeah, it's just a lot of fun. It's and I think in 30 years it's going to be where you want to be, because I think the dollar will be worth, not much, because I don't see how else we're going to pay off all of our pension debts and all those, off-the-book liabilities without inflating our way out of them.
Talk to me a little bit about the future. So you mentioned 30 years from now. Is this something, how do you think about how they change the landscape of finance? Is this become a staple of investor portfolios? Are people going to use it mainly as a contender in the currency space? What's your general beliefs here as we look out to the horizon?
Well, yeah, it's not going to replace stocks. It's just going to replace dollars, I think, eventually. Like in 100 years, I think it'll be crypto, not fiat money, because the governments will have, they're going to blow up all their credibility. And you're going to want to go to something that's trustless, that can't be monkeyed with by politicians. So in the long run, that's the currency you want to be in. But the companies are going to still have to exist, and there'll always be a profit rate for companies, because if there's no profit, there's going to be no companies. So, and the profit rate in the U.S. has been kind of constant over the past 100 years, contrary to what Marx thought when he thought that the profit rate would go to zero. That's just an equilibrium, and so they're going to make whatever the money is. But I think it's at some point there's going to be a tipping point. It's going to be episodic. There's going to be some big events, and then Bitcoin or Ethereum or someone's going to take over, and that's going to be that'll be the means of payment.
Well, just promise me when you launch your low vol crypto fund that you instead brand it as the defensive or conservative crypto fund.
I'll do a tactical. Tactical is good. A quant tactical crypto.
Talk to me. We're going to bounce around. We've kept you long enough. A few more questions that I think would be fun. One, you've published a few books, but I thought one of the more interesting was this concept of your book, Maxims. You want to tell us what the history of that was?
Oh, yeah, that was fun. So my son was leaving to college, and it's your kid, and you want him like, oh, geez, what are some good things I want him to know? And so, I would think, I should really have him know, moderation in all things. That's a really good thing to know. And then I wrote down like some of my other favorite ones, and I like quotes, so I kept a couple hundred quotes. And so then I thought, well, I'll just put it in a book and give it to him. And so it was just fun for him, or fun for me. And what you find is, if you want to understand life, it's not like know one thing. There's like lots of things to know. You have to know. It's not like, all you have to understand is love or know thyself or whatever. But there's like a couple hundred things you should know, and quotes are the easiest way to learn them. And so I put those in a book, and it was really cool because I could do it online, and it was like $5. And so I'm like, great, just something. You want. I was really worried, if I got killed or something, and I wanted my son to know. Oh, it's really important to know. Whatever, to be great is to be misunderstood, or knowledge can be communicated, but not wisdom, or 90% of everything is crap.
I liked a couple of them, but the under the purpose tab was seek above all for a game worth playing. I think that's a great commentary on a lot of what you and I spend our time thinking about, and it's deeper than the quote sounds.
Right.
But I loved it. So. Did anyone else buy the book?
Yeah, actually I sold a couple. I sold actually about 250 of them, so not bad.
Wow, that's great. That's awesome.
I just priced it at kind of like, par, so it's not a big deal. I'm just, it's a fun thing to do for your family. Actually, it's really cheap to do.
So for someone who's got a curious mind, thought about all sorts of different stuff in his career, anything else that's you sit back in your chair that's got your brain worrying, anything that you're thinking about these days, whether it's markets or anything else? I imagine a lot of it's crypto related, but what else is on your brain these days?
Just about that. I became a Christian a couple of years ago, so I spent a lot of time in Bible studies now and do a lot of that stuff, but that's kind of off topic. I find that very rewarding. But I mean, I like to just read lots of stuff about science and finance and keep up on that stuff. But there's a lot of interest. There's always more books I want to read than I can, and so there's always any favorites lately. I need some good inspiration. I'm in a lull. I find myself more and more. Last half dozen books I've been through, really struggling with them. Any favorites of the past year or two? By the way, this question is impossible for me to answer. Yeah, off the top of my head, let's see. Yeah, I've been doing a lot of the Bible study type books, which is interesting. But I don't remember the ones I really liked.
All right. Well, if you think of any that were astonishing,
I'm a big fan of Jordan Peterson. I really liked his 12 Rules. So I get that to my son too. That's a good one for him, I thought.
Perfect. Haven't read it. So as you look back over your career, and I think we already did the punchline in the beginning of the talk, but you may have to think of number two. But we love to ask the guests, what's been your most memorable trade or investment over the course of your career? And if the puts is number one, you have to answer is there another one that comes to mind? Anything in particular that really stands out?
Well, after that, I remember I was a little overconfident, so I thought, I'll trade these things. So I remember back then I had to call on the phone, and then I wanted to buy a put on or a call on a specific stock because the Fed actually lowered interest rates right away, and so via the Minsky model, where the Fed really kind of controls these things, I was confident that the market was going to recover, which it did. But I picked out a specific company because I figured, so I remember it was bought it was some retail company like May Company or May Stores, and I bought an out of the money call, and it was trading at like $1.25, and they said, and then they called me back 5 minutes later and said, you got filled at $1.75, and I'm like, I got it just as it's going up, great. But then I realized the price didn't change. So basically the bid-ask spread was like, you buy it for $1.75 and you sell it for $1.25. What's the transaction cost on that? That's like, I don't know, a quarter divided by what the true value is 1.5. So anyway, the spreads on those options back in the late 80s were so high, just 2 or 3 trades, and I was down like 40%, and the market didn't move. And I'm like, what's going on?
That's actually a pretty, I think, useful example. A lot of people spend almost all their time thinking about, the right investment and so little time thinking about the plumbing. I was getting into fees and transaction costs and all the boring stuff, taxes. I got into a bit of a Twitter fight this morning because I was giving a really hard time to this very hot startup that has like 4 million users, that it's a savings and investment app. And, they make it sound like it's a great deal because they only charge $1 to $3 a month. But in reality, the average account size is only $250. So these people are paying 5 to 15% per year, and they're registered as an investment advisor, so technically fiduciary. And I said, look, it's great that all these millennials hate going into branch banks anymore, but in the meantime, you're paying 10, 15% a year on a savings account. So, and man, you should have seen the reactions, many of which were, what are you talking about? I don't pay any fees.
Yeah.
Right. So it's the important stuff is often not necessarily the investment side, but everything else.
Yeah, free is always the most expensive way to do something. Yeah, when somebody says like, I don't measure my trading costs because I've got bigger fish to fry, it's like, no, you don't.
Eric, where can people find if they want to follow your updates, writing, everything else? Is the blog the best place? Where should they go?
Right now, I'm basically most active on Twitter. I don't update my blog much anymore. You can do E.G. Falken, Eric George Falkenstein, E.G. Falken at Twitter. I type in my name, and I'm pretty much off the grid now. Especially doing my crypto stuff. I can't really talk about that too much because I am trying to create a fund, and so. And so that's, there are all those restrictions on that and stuff.
I hear you. Well, look, we'll post show notes, links to your books and papers and the best places to get in touch with you, and people can pick fights with you on Twitter as well. We'll post links. Eric, it's been a blast. Thanks for taking the time to join us today.
All right, great, Meb. Nice talking to you.
Listeners, thanks for sitting in. We'll post the show notes I mentioned on the blog at mebfaber.com/podcast. You can always subscribe on the various apps, Overcast, Breaker, Stitcher, and leave us a review. Got over 400 5-star reviews. I promise we read every one of them and love it and really do appreciate it. Thanks for listening, friends, and good investing.